Hello and thank you for joining us today. My name is Wesley Boudreaux, one of the ExxonMobil focused advisors here at the Retirement Group. Today we're talking about retiring on purpose with purpose and what that process can look like and some things to be aware of as you transition from an ExxonMobil employee to a retiree, hopefully. Before I get started, a couple quick reminders. If you do have any questions throughout the course of this webinar, there is a Q&A box, so feel free to jot that information down there. Your name is anonymous, so we will not divulge that. We'll try to get to as many of these questions as we can at the end of the webinar. There's also a chat box, so we'll put some information in there periodically, things like how to follow us on LinkedIn, how to schedule an appointment with myself or one of the other advisors in the office. Maybe a survey to ask us how this seminar went, or if you have any other suggested topics going forward as well. And then a quick reminder, even though we've worked extensively with ExxonMobil employees, we're not employed by ExxonMobil, nor are we endorsed by them. But let's go and get into what we're going to cover today. But again, a quick reminder for those of you who may not have been on one of these webinars or haven't sat down with us before. The Retirement Group, we are an independent financial advisory firm that focuses on working with corporate employees and help them transition into retirement. We've been doing this for about 30 years, and for a large chunk of that, we've been doing it with ExxonMobil employees. So the benefit of doing that, it gives our advisors a deep focus on your specific your specific benefits plans, whether it be the pension plan, the 401k, healthcare, retiree medical, life insurance, all that transition process we can walk you through and help you understand the best options so you know the right time to retire so you maximize those benefits from ExxonMobil as well. We do have offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, we can probably still accommodate that, but obviously this day and age, it's very easy to have web meetings, phone calls, emails, whatever your preferred communication method is, just let us know. And ultimately, at the end of the day, if there's anything you take us up on, it's our complementary cash flow analysis. Even if it's been over a year since you've done this, there's obviously been a lot of changes in interest rates in the stock market. So your 401k may have changed, especially in Exxon. It's gone up since the last few years. But as far as looking at that cash flow analysis is a complementary plan. Give us about 10 minutes, 15 minutes or so to gather some data from you. Give us about a week to put that plan together, and it'll be a detailed plan to show you your various retirement date options. Whether you want to look at retiring in 3 years, whether you want to see, hey, can I go earlier? Should I take the pension lump sum or the annuity or a combination? Because Exxon gives you that choice of the breaking it down 25% intervals. So we'll go through all those different options and show you not just how it looks like now, but how it looks 10, 20, 30 years down the road so you can truly plan for the right day to retire for yourself and your family. So let's talk about our comfort checklist, if you would, as we transition to retirement. We've been talking about this for the last 15 years, I think, or so. But really, there's a couple different things to really be aware of and make sure that transition is smooth. And first and foremost, it's to be comfortable with that decision and understand your emotions. We go through an entire webinar and seminar on the emotions of investing and retirement. But as far as the process, by going through that cash flow analysis I mentioned before, that should hopefully get you comfortable as far as where you are in the decision process and when to pull that trigger. We're going to be happy to tell you, financially if you're ready to go or not, but you may not be ready emotionally. You may say, hey, I want to make sure I make it to 40 years. I want to retire when my son graduates from college or something like that. You may have some arbitrary number. Our job is to tell you financially when the best time is to retire, but you still need to be emotionally ready to make that decision. Got a lot of individuals we work with that could have retired 2 or 3 years ago, but they associate their life with work, and that keeps them going. And vice versa, there's people that we've told, hey, you need to work another 2 or 3 years, but they just were ready to go, and they emotionally were ready to get out of the company at that point in time. So there's a combination of those two things, and obviously you also need to have your emotions in check when it comes to the investment process, whether you keep things in the ExxonMobil 401k plan or roll them over to a Charles Schwab IRA and work with Retirement Group. We need to run through that cash flow analysis, understand what you're trying to achieve, and set up a long-term strategy to help minimize your risk and help you understand that process. So again, your emotions don't take control as there's market shifts. So one of the best things about doing that transition to retirement is understanding what your investment philosophy is. For a lot of you, it may have been just kind of keep your head down and invest in the equity units or the ExxonMobil shares, or maybe some of the common assets and stuff as well. But ultimately speaking, if you're more aggressive, that's great as you're building up your nest egg. When you get close to retirement, you need to look at that allocation and typically become a little bit more conservative. And you want to look at reducing your risk and volatility. So a lot of that comes by the asset allocation, also tactical allocation, and also the investment selection, as far as, especially in times like this, focusing more on value companies and companies that have cash on hand, companies like ExxonMobil, essentially. But at the end of the day, we also want to help you increase your retirement income. And I think we do that by, three different scenarios. So even if you don't work with us, the first scenario is running that cash flow analysis. So we can let you know the best time to retire so you maximize the benefits from Exxon. So you walk out that door with a higher starting value. And then by helping you decrease that risk and volatility, that's another way to maintain that level of income that you're looking to achieve throughout the rest of your life. And then ultimately, you want to make sure you keep as much as you can in your own pocket and keep Uncle Sam out of that. So we're going to help you with tax planning strategies, whether it be where to withdraw your assets from, whether you should look at Roth conversions, how to mitigate some of the different tax situations with Social Security and Medicare, and how those can change over time as well. So ultimately, we want to focus on doing that as well. And this is something you can do on your own, but obviously, having done this for 30 years, we believe that working with a team of investment professionals is a great way to do it. But again, if you have any questions, feel free to give us a call. We can dig into these different options for you. So as far as understanding the key changes, let's talk about a couple of things we'll go through here. Understand your pension with the ExxonMobil plan, first and foremost. We're also going to look at how real estate can potentially impact you and how it's changed over the last year or two. Talk about inflation. That's obviously been a big situation here over the last year and a half. And then how to avoid mistakes as far as that transition process by working with an investment management team like the retirement group. So first and foremost, for ExxonMobil employees, as you transition to retirement, there's really a three-legged stool as far as your potential income, and it could be a fourth leg if you've got some real estate. But the main three legs we always talk about is going to be Social Security. So everybody's going to have that option of taking Social Security as early as age 62 or deferring it all the way to age 70. Obviously, the longer you defer it, the more you're going to get, but you have to factor in longevity into that. And also, if you're married, looking at spousal benefits and things of that nature. So any question on there, we can do a full Social Security analysis, give you all the claiming strategies to help you determine the best time to pull that trigger. Then you've also got your pension, your 401k plan. Now, the 401k plan is your ExxonMobil savings plan at Voya. That is, again, your defined contribution plan, where your contributions and Exxon's match is defined. The results, as far as based upon your investment selection, that's not defined. So it's going to go up and down based upon your investments. And once you retire from ExxonMobil, you have the option to keep that in the 401k plan and take withdrawals. Now, there's very limited withdrawal options, either one or two per year. Generally, most people, what they do is they roll it over to an IRA. And again, if you want to work with the retirement group and Charles Schwab, we can roll that to an IRA, help you manage that, and set up a direct deposit to your bank account to cover your expenses on a monthly basis or however often you want to set that up. And the same goes for the pension. The pension is actually a defined benefit plan, in which case the benefit you're going to get is defined. As far as the single life annuity, then everything else is calculated from there, whether you want to do a joint survivor or a lump sum. Interest rates, which we'll talk about in a moment, is what drives the lump sum calculation. So that will change. But if you take the pension as an annuity, you're going to get that fixed payment for the rest of your life. If you decide to take it as a lump sum, you can roll it over to that same IRA I just talked about and set up your own investment strategy, whether you're looking at an investment allocation or whether you're looking at your own income annuities or things of that nature. There's a lot of different options out there to review on there. And then the fourth, like I mentioned, is potentially if you've got real estate, maybe you've got some rentals, or maybe you're looking to downsize and maybe sell your house and pocket some money. Those are some different options we see some people go through as well, as far as a fourth leg in the stool for income. So let's talk about understanding your pension. So the interest rates are going to impact your lump sum, as I mentioned before. If we go and take a look at, the kind of the seesaw approach here, when interest rates go up, which they have been going up dramatically over the last year in 2022, you're going to see your lump sum go down. And the opposite happens. When interest rates go down, which we saw during the pandemic, we saw lump sums go up and hit the highest levels we've ever seen in the history of the ExxonMobil pension plan. So what happened was when those interest rates, let me step back. So the way they're calculated is you take a look at your initial calculation method is your single life annuity. So everything else is based upon that. So let's assume you have a single life annuity for $4,000 a month for the rest of your life. Maybe you are married and you want to do a joint survivor annuity for 75% continuation for your spouse. So you're not going to get $4,000 a month anymore. It may be, $3,600 or $3,700 or something like that, because they're paying on the course of 2 lives now. So there's more risk on the table for ExxonMobil to pay out for a longer period of time. Now, if you want to get that lump sum, what they do is they use interest rates to calculate the net present value. So what they do is they go and look at, okay, what's your age? What are longevity tables showing? So let's say how many more years are we potentially liable to pay you? And then they use that to calculate out the net present value with the current interest rate. So if the interest rates are higher, they don't have to give you as much money for you to go out there and essentially recreate that same annuity paycheck. If interest rates are lower, they have to give you more. So kind of like if you think about a mortgage, when interest rates are low, you can afford a bigger house. When interest rates are high, you can't get as big of a mortgage. So generally speaking, when we see those interest rates change, that about a 1% change in interest rates is going to equate to about an 8 to a 12% change in your actual lump sum, depending upon your age. The younger you are, the bigger that change is. The older you are, the less severe that change is. So just keep in the back of your mind, a 1% equals 10%, and that's a good rule of thumb. But again, we can go through the pure details with you and give you updates on the interest rates and show you how to estimate your pension and tell you exactly how it's going to affect you going forward. But let's take a look at those interest rates, because that's what everybody's been kind of concerned about over the last year. And let's face it, we saw the biggest change in interest rates we've ever seen over the last year or so. And hopefully, we're going to say that most of that change is behind us. The last 2 months, as far as the updates on interest rates that the Fed puts out, have actually come down a bit. So hopefully that trend continues, and we should see these rates maybe come down in the next year. By no means are they going back down to where they were pandemic levels. They were artificially low because the government drove them down that low. And then on the flip side, inflation kind of came through. We knew it was coming through. We didn't expect it to go as high and as quick as what it did. So kind of that pendulum has swung from one end to the other, and we'll kind of go back and forth to a level off, hopefully closer to long-term rates. So anybody that was looking at leaving last year, I know a lot of us, we talked with you about it second quarter, kind of first or second quarter. And then we've seen it kind of move up since then as well. But the good news is going forward, we should see it start to come down hopefully a bit as well. So how are those interest rates used? There's actually 3 or maybe 4 different interest rates. First, there's the GAT rate, which is used for the grandfathered employees. Those are the older employees that have been around for a while, that are at least 65 and been there for 25 years as of the end of last year, 2022. If you're under that plan, then you've got a lower interest rate and a higher lump sum. The GAT rate's going to follow the 30-year Treasury average times 95%. And that's where you're going to get that. And we'll go through those rates in just a moment on this chart. But for most of us, it's going to be under the segment rates, the Pension Protection Act segment rates. And there's 3 different segments that correlate to retirement. There's the first segment is going to be for the first 5 years of retirement. Second segment, years 6 through 20. And the third segment, years 21 and beyond. So for most of us, that second segment is going to have that highest weighting because it covers 15 years of retirement. The younger you are, the more additional weighting that third segment will have, and the older you are, the less significant that third year will be. But for most purposes, we want to look at that second segment as a good idea of where things are. So let's kind of take a quick zoom in here. And what they do is they use the average of the second and third month of the prior quarter. So we got December rates out late January. So now we know, based upon November and December, that first line in blue, what Q2 is going to be for 2023. And it's 4.97%, 5.38%, 5.13%. And for grandfather's employees, it's a jump to 3.75%. So if we go into right now, Q1 2023, it's 4.14, 4.94, 4.88, and 3%. So let's go again to the middle numbers there and take a look at that. So that second segment is jumping from 4.94 up to 5.38. So a little bit over 40 basis points, so about a 4% drop or so in your pension lump sum from first quarter to second quarter. However, the bigger issues for those of you who are grandfathered, we talked about, I think we got a few different grandfather employees out last year. We were down at that 1.75% level or so, but it's gone up to 3%, and now it's jumping from 3% to 3.75%. From first to second quarter. So if you are grandfathered and you're thinking about leaving this year, it may be something worth looking into right now, because that 75 basis point jump could cost you about 7 to 8% or so on your pension lump sum. So if you had $1 million lump sum, it could be going down by 80 grand roughly just from this quarter to next quarter. Now, if you look at the below there, we've got the history just to kind of give you an idea. If you go all the way back to first quarter of last year, you can see that second segment was actually down at 2.53%. So you can see how high that's come. That's moved over 25, 2.5%. So over 25% drop or so over the last year with that lump sum. But like I said, if you haven't retired already, most of that's hopefully behind us, and it's going to be beneficial to possibly hold tight a little bit unless you were looking at retiring this year. At the beginning of this year, and then it's a factor of looking at Q1 versus Q2. But if you're thinking about working later into the end of the year or into next year, hold tight. You might see these interest rates start to come back down a little bit and be a little bit more favorable for you. So let's talk a little bit about real estate. This is kind of again, it's not for everybody, but because of what was happening over the last year or two, we decided to put this in here and kind of talk about some different options. And some of those have slightly changed, obviously, with inflation creeping in and kind of softening the housing market. But one of the biggest things we talked about was a lot of people had a fear that as the prices of housing went up, was it reflective of 2007, 2008 and that real estate crash? Yes and no. I mean, one of the biggest things was the supply issue. There was more supply back then. If you remember how much they were building, in 2005, 2006, 2007, just overbuilding. I can remember sitting down with people, and it wasn't just people that couldn't afford houses. It was people that were buying $2-3 million houses they couldn't afford. The banks were just lending like crazy. So we don't have that issue anymore. Also, there's not as much of a supply issue, and as far as the replacement cost is pretty significant now because inflation is built in there. So building a new house is going to cost a lot more. So there's still some cases where obviously the market's softer, but if you were potentially downsizing or something like that, that's something to consider. Whether you're downsizing and staying in the same state, that's one thing. If you're looking at changing states, maybe you're moving from California to Texas or New York to Florida. There's a big change in state tax regulations and stuff too. So we want to look at all of that with you. But a lot of times you may look to downsize, maybe pocket a little bit of money so you can have that for additional investment strategies. Or in some cases, maybe you're downsizing, but you're getting the best of the best quality. So you might not be making much off you might essentially be selling your bigger house and buying a smaller house for the same price. Or maybe that you look to maintain your house and rent that out because you don't have a mortgage on it. Or maybe if you had a mortgage you refinanced a couple years ago, it was a very good rate. So all these different things kind of come into play as well. If you have questions on real estate, we can make sure we embed that into that cash flow analysis to help you out there as well. And the biggest thing I know a lot of us have been concerned about is inflationary pressure. We've been talking about this for the last year and a half, 2 years. We knew it was coming. Like I said before, we didn't necessarily expect it to come that quickly and that high back last year in 2022. We've seen it kind of subside, so hopefully that is the case. Time will tell. We'll see what happens with the Fed rates here moving forward as well. But again, unfortunately, a lot of times when inflation rears its ugly head, that does drive up prices, and once it kind of subsides, it doesn't necessarily mean they're coming back down. I mean, retailers and stuff are typically going to keep those prices high, so we have to deal with that as well. At least it did move up, the cost of living adjustment for Social Security and some of those items. And obviously there's differences as far as how you want to manage your assets. Obviously bonds, when inflationary pressure hits, is something that has significant risk because you've got the interest rate risk. So what happens is kind of like we talked about the lump sum. When interest rates rise, bond prices go down. So a quick example would be, let's say ExxonMobil built a new refinery or something like that, and they were offering the bonds for 5%. So you got 5% payback per year for 30 years until you got your money back. But if we fast forward and interest rates go up and they wanted to build a new refinery and now they were offering those at 7.5%, nobody would want your 5% bond because, again, they can get a 7.5% right now. So if you want to sell that 5% bond, you'd have to sell it for a reduced value. So instead of $1,000 a bond, you might have to sell it for $950, $945, $960, something like that. So that's where you have that reduction in price of bonds. Now, in a bond portfolio where you're constantly investing and changing those, you also will see the interest rate rise over the long term as well. But in the short term, when interest rates spike, and like we saw last year, the biggest spike we've ever seen, we saw one of the biggest hammerings of the bond market we saw as well. I think it's down about 13% for the year, whereas the market was down about 18%. So first time we've had something that significant where those are side by side. We've had it, two other times where both stocks and bonds have declined, but nothing to that level. So hopefully going forward, when we get things stabilized, we'll see a good rebound in that in the bond side as well. And then lastly, we talked about a couple different things, but ultimately we do believe that the best way to kind of tie all this together and make sure you avoid mistakes is working with an investment management team. And obviously we'd recommend working with the retirement group. If you were to do so, we clear through Charles Schwab, so we would open up a Charles Schwab IRA and get you set up that way. But even if you don't work with us, permanently, it's still good to reach out to us and run through all these review topics we talked about, just to at least check, make sure you're on the right page with what you want to do. So a lot of things to understand if you decide to work with a company and not do it on your own is make sure they understand your benefits plans inside and out. I can't tell you how many times we've sat down with people, maybe too late, it was after the fact, they already pulled the trigger, and we told them, hey, look, if you would have hung on for 2 more weeks, or if you would have gone earlier, you would have made another $30,000 your lump sum. Or differences of the Social Security offset, a lot of different things that we've uncovered that your other advisor may not, because they're not used to working with ExxonMobil. Make sure you understand the fee structure. Obviously, we charge a fee. We are fiduciaries, so we're transparent on that, and we're not a one-size-fits-all firm. So we don't have a cookie-cutter approach where everybody goes on the same investment strategy. Our goal is to run that cash flow analysis back into what you're trying to achieve and provide you choices and options on how to achieve that and let you decide what the best fit is for you. And make sure you're working with an investment management team. I can't do everything on my own, nor can the other advisors here. So we've got our back office support that helps us set up the portfolios. We've got the back office support with Schwab and the research team there, and other companies that we utilize as well for our research efforts in order to make sure we put together the best plan for each individual person. And at the end of the day, just figure out what is it that you're looking to achieve and what's most important to you, whether it's tax management planning, a good website, healthcare planning, estate, legacy planning. We can cover all those, but just make sure you let us know what kind of your hot topics are, or so we can kind of dig into those more appropriately. And at the end of the day, like I said before, that cash flow analysis is the best way to actually kind of see where you stand, determine if you're on the right path. Could you retire earlier? Do you need to work longer? Do you need to cut your expenses? We can go through all those different options with you, but not until you go through that will we be able to give you a true investment analysis and tell you what the best next steps are. So don't let anybody fool you. Don't talk with any advisors that are telling you what to do without knowing the overall situation as well. And also be careful if you're retiring before 59 and a half, don't let any advisors push you to roll everything over to your IRA as well, because there's different tax rules on that as well, where we actually recommend keeping money in the 401k plan at times. So again, I mentioned this multiple times throughout the course of this webinar, but ultimately, if you have any questions, want to dig into a financial plan, just let us know. Right now, about 3/4 of Americans over 50 don't even have a written plan. If you can spend about 10, maybe 15 minutes with us gathering or updating some information, we can put that plan together for you, get it back to you in about a week, set up a phone call or web meeting to kind of go through that in detail, and then make any adjustments you want to see, and we'll be able to tell you. We can run multiple scenarios, whether you want to look at retiring at 2 different dates, whether you want to look at the lump sum versus annuity, or a combination 50-50, 25-75. We can go through all those different options with you in that cash flow analysis. So with that, I'm going to wrap this up, see if we've got look like a few questions came through, so we'll get over to that. But again, any questions you have, just simply give us a call at 1-800-900-5867. You can also reach us at info@theretirementgroup.com. And there's a couple QR codes we'll leave up here on the screen while I go through the questions, so you can use your cell phone. One is to get into our calendars. If you'd like to schedule a meeting with myself or one of the other ExxonMobil focused advisors, you can use that. Keep in mind, this actually it gives you about a week out, so if you need to do something sooner, give us a call. And there's also one for the LinkedIn to get a hold of us on LinkedIn. So if you want to follow along with our LinkedIn site and our ExxonMobil specific site to give you updates on different webinars coming up, plan changes, interest rate changes, how it affects the pension, and things of that nature as well. All right, so let me catch my breath a little bit, get into some of these questions. We got a few that came through. First one, can my pension be adjusted by ExxonMobil to account for inflation? I have been with ExxonMobil 26 years, and my lump sum option is grandfathered. Okay, so two things. The second one's really kind of a statement. So whether you're grandfathered or not, that's not going to change anything as far as the flexibility of the pension. What it does change is going to be the interest rates they use to generate your lump sum. So somebody who's grandfathered, so this person says 26 years. If they're over 65, then they are grandfathered. And what that's going to mean is they have a lower interest rate that's used to calculate that lump sum. So their lump sum, compared to if they didn't have the 26 years, would be a little bit, their lump sum as a grandfather employee is a little bit higher than what it would be if they were a little bit younger or they weren't grandfathered. So that's the one thing there for the grandfather aspect. But as far as, is there like a cost of living adjustment or something like that, is maybe what the question's asking. No, ExxonMobil does not have a cost of living adjustment. So if you go in there and you factor in your pension, and let's say your pension is going to be $4,000 a month for the rest of your life, it's $4,000 a month this year, next year, year 15, year 20, year 30. So that's not changing. So obviously with inflationary pressure, we're going to see an erosion of that purchasing power. So that $4,000 a month is not going to buy as much as time goes on. So there are options if you want a cost of living adjustment where you can take the lump sum, get your own annuity that has different features like that, but Exxon does not have that. Now, if you took that lump sum, then obviously that's where a lot of people, they take that lump sum for a couple reasons. One is because they want that inflationary hedge, that cost of living adjustment, so they can possibly spend more as time goes on. They want to take control of those assets and manage them for good or bad. Again, you have to be able to manage them more appropriately to try and outperform what that annuity could be. And there's also a lot of times there may be longevity issues, or making sure your beneficiaries beyond just your spouse are covered. Maybe if you've got fears of passing away sooner, you got family history, then the annuity is not going to be as beneficial for you. You'd rather take that lump sum so your beneficiaries can get more of it. Or again, if you do it, even if you do a joint and survivor annuity, if both of you pass away sooner in life, then Exxon keeps the residual. Whereas if you were to take a lump sum, you know you're locking in that amount to pass on to your spouse or your family if beyond him or her. And there's other ways to do annuities that will provide kind of a combination approach. But you need to look at the interest rates each quarter as that time comes on. Okay, my coworker left in order to lock in a lower rate. Can you explain why this makes sense for a grandfathered employee? Okay, so again, this makes sense for anybody, not necessarily just a grandfather employee. So again, there might have been a confusion on the grandfather versus non-grandfathered. The only difference in grandfather versus non-grandfathered really is going to be the interest rates used to calculate the lump sum. So you still have the same issues with the annuity and the lump sum. Now the difference, like we showed before, is in some quarters it could spike more or less for one of those. But we saw a lot of people last year, and we talked with a lot of people. Actually, to be honest with you, if you go back a year and a half, 2 years, we had a lot of people that were telling them to kind of, hang on a little bit because interest rates were driving down during the pandemic. And then once they started to move up, at the end of 2021 into 2022, that's where we had a lot of people take advantage of leaving and locking in those low interest rates and the high lump sum. And we saw a lot of people kind of, I don't want to say him and haw, but kind of just watch it last year and unfortunately see a couple, big jumps behind them and then finally kind of pull the trigger to leave. And so yes, if you leave as interest rates are rising, you're locking in a lower interest rate, which is locking in a higher lump sum. But this again is beneficial for anybody, whether you're grandfathered or not. The issue needs to be, though, we need to look at that cash flow analysis, find out do you have a sufficient enough assets in order to actually retire now, not just let that pension drive that calculation. Also, like I said, a lot of that over the last year is hopefully behind us. We'll see hopefully a leveling off here. It is moving up again, first quarter, second quarter, but the monthly inputs are starting to level off. So hopefully in the third quarter, we'll see a drop back down. By no means are we getting to where we were during the pandemic. Otherwise, we got some major economic issues on hand for that. But at least we could hopefully level off. But yeah, so if you're looking to lock in as interest rates are moving up, you can do that. If interest rates start to go down, then we would actually recommend people, even if you retire, let's say if you retired second quarter, but we saw, and you want to take the lump sum, we saw interest rates were actually dropping, we would tell you, yes, you can retire, but do not commence your benefits yet. There's two different dates. There's retirement date and your benefit commencement. We would say go ahead and defer commence your benefits until these interest rates drop a little bit more so you get a bump or a raise in that lump sum. Now, to add another aspect to it, if you're not 60 yet, then you're not getting 100% of your pension. So maybe you retire at 57 and interest rates are on the decline. We're going to tell you to stay on for two reasons. Not stay on, but defer commencing for two reasons, because you're going to get a bump in your lump sum for the interest rates going down, plus you're going to be aging out of the age penalties, where there's a 5% reduction for each year you take it prior to age 60. Okay, I read an article about using my pension to buy an annuity rather than taking an annuity from ExxonMobil. Can you tell me if this makes sense? Okay, I kind of alluded to, I mentioned that before as far as some of the flexibility measures. Last year it made a lot of sense because we were coming off kind of a unique situation where I'd say historically, I don't think it ever really made sense to take the lump sum and annuitize it because the Exxon annuity calculation was much more superior to that. The only reason to have done that in the past was maybe for more bells and whistles. You want a cost living adjustment, some options. You want to make sure beneficiaries beyond your spouse are covered. But last year was more unique where we were still having some high lump sum calculations, but because of the driving interest rates, that drove up private annuities. So your annuities from companies like Nationwide, Prudential, Allianz, Bright House, all the different big players. When interest rates go up, that's allowing them to pay a better annuity rate. And when I talk about that, I'm talking about a SPIA, a single premium immediate annuity. So that's the apples to apples comparison to what the ExxonMobil plan would be giving you. So we saw cases where people were able to actually take the lump sum and get their own annuity and get, $3, $4, $5, maybe sometimes $1,000 more a month than what the ExxonMobil annuity was paying. Now, fast forward, the interest rates have kind of come up now, so that may not be the case, but it's still something that's worth reviewing, where it may be more kind of hand in hand, where the Exxon annuity and a private annuity may be very similar. One might be a little bit better, not a major factor, but a little bit better. But the other aspect there is, like I said, there's other bells and whistles you can do with doing your own annuity. Even just on that single premium immediate annuity, the difference is you can do the same thing with the cash refund options. Let's say your lump sum is $1 million and it may be that you only need 800,000 or 900,000 of that to do the exact same annuity as what Exxon would give you, or maybe you need a full million. The difference is you can make sure that $1 million is protected. So God forbid something happens to you earlier in life and you pass away. Maybe you spent down 200,000 of it. The remaining 800,000 is still going to your beneficiaries. Whereas with ExxonMobil, if let's say you passed away and you didn't have a period certain on it, you passed away in year 8, then they're keeping the rest of that. So that's one aspect of it. And there's also the ability if you want to add a cost of living adjustment to it. And then you can go even farther if you want to do variable annuities or fixed index annuities. We're not going to get into all that, but there's a lot of different bells and whistles you can do to have more flexibility and control of that if that's something you want to do. So ultimately, yes, it still may make sense, but it depends quarter by quarter, those interest rates and looking at what those options are. So just let us know. We can always run through those with you. I've heard that some employees at ExxonMobil may not have a lump sum and only get an annuity. Why is this? Okay, so this is and this has actually kind of changed this last year, and we'll see how things kind of move forward. But the thing we've always told you, remember, was 55 plus 15. You need to be 55 years old and have 15 years of service in order to be considered a retiree and not a terminee. Now, the retiree has a lump sum option. A terminee does not have a lump sum option. So if you, let's say, retired at 53, or you retired at 57 but only had 13 years of service, you were considered a terminee. And unfortunately, this happened to a lot of people where maybe some of the different refineries were sold off to different companies, and maybe they gave you a bridge, maybe they didn't, but unfortunately you were considered a terminee, so the only thing you had option was that was the annuity. So that's the difference there, where you only get the annuity. Now, the caveat is, last year they've actually come out and they've been doing some buyback options where some of those individuals that were terminees and only had the annuity option were given an offer to actually take the lump sum instead. So the reason they've been doing this, and they've been doing it kind of quarter by quarter, is let's look at the aspect for ExxonMobil. If somebody's got an annuity, let's say Exxon's going to pay you $1,500 a month for the rest of your life. How long are they paying you? They have no idea. The actuaries can do estimates and stuff, but ultimately, from an accounting standpoint, they don't know how long you're on the books and how long it's going to cost them to make those payments. So if they can actually go in there and give you a cash buyout, a lump sum, get you off the books, that's something that's beneficial for them, because now they're able to, for accounting purposes, have a better understanding of where their finances are. So we've seen a lot of that happen. So again, very simply put, a terminee who's not 55 plus 15 is going to not have the lump sum option. However, we're seeing some of those options kind of come through, and it may just be in this last year or so. So it may not be something going forward either. Okay, what tax differences are there for a lump sum versus annuity? At the end of the day, there's really no tax differences. They're both tax deferred situations. Whenever you take that money out, it's going to be taxable. So the difference is with the annuity, if you turn that on, you're getting that on a monthly basis. You're getting taxed every month or every year for that. Whereas if you take the lump sum, let's assume maybe you don't need it for the first year or two. Maybe you're going and contracting or doing something else. You don't pay any taxes, so you physically take that money out from your account. So if you were to roll that over to an IRA and start taking an income stream, then they're 6 and 1/2 dozen the other. They're the same thing. You're getting taxed on both of those the same way. The difference is with the lump sum, you can defer it and you can pick and choose how much you want to take in different years, so you can manage those taxes better. That gets to another strategy. If you look at the aspect of RMDs, at some point, whether it be 72 or now 73 or maybe 75 after 2033, you're going to be forced to start taking distributions. And if you've put everything in your IRA, your 401k, and you haven't touched that because you've been living off the annuity, now that RMD kicks in, you're going to be forced to start taking out a certain amount on top of the potential annuity and Social Security. So it could drive you to a higher tax bracket. At that point, you really have no control over your taxes. If tax brackets go up to 50% or 6%, it is what it is. You're stuck paying those. Whereas taking that lump sum and rolling it to an IRA, you have more ability to do Roth conversions year by year to kind of get some of that out of that IRA and reduce some of the potential tax in the long run. Or you have the ability to pick and choose when you want to take withdrawals. So there's more flexibility there, but obviously there's more risk as well on the investment side. Okay, last one, we'll get this wrapped up. Okay, I heard the RMD age is changing. If I'm 72, do I need to take a distribution this year or next year? Okay, so yeah, it is changing. The Secure Act 2.0, we had Secure Act come out December 2019 that kicked into 2020, which bumped it from 70.5 to 72, so a good thing there. Now Secure 2.0 is out, and that's changing it to 73 starting this year in 2023. And then it's going to bump again to 75 in 2033. So that's farther down the road to look at. But it's going to depend upon this person who says, I'm 72. When did you turn 72? If you turned 72 last year in 2022, then you're on the RMD schedule already. So your RMD started last year, and that's kicked in. You have to stick with that. If you're not if you haven't turned 72 yet, and you turn 72, and you don't turn 72 until 2023, then you are able to defer that out and not have to take that till age 73. So again, this is a good benefit where you're able to defer an extra year. Gives you more flexibility as far as taking distributions and an additional year of a potential Roth conversion options without having to satisfy that RMD first. So there's a lot of questions through there, but let's go ahead and wrap this up. A quick reminder again, even though we've worked extensively with ExxonMobil, if you have any questions on the plans, let us know. We can go through that with you, run that cash flow analysis, but that does not mean we're endorsed by ExxonMobil nor employed by them. But again, just give us a call, 1-800-900-5867. Ask for myself or one of the other advisors. We'll be happy to dig into that with you and give you exactly what you need as far as telling you where you stand and what your options are with Exxon in that transition process, and then talk about the investment strategy should you want to go down that road. So I want to thank everybody for joining us today, and we hope you have a great day.